Hello. So today we're joined by Tobias Citron, principal at Primary Venture Partners. Where are you dialing in from today, Tobias?
Hey, Julian. It's great to be here. I am dialing in from Primary's office in New York City. Excited for the conversation.
Awesome. Yeah, we love to have venture capital people on, and especially ones who went to Wharton. So very excited for this episode. Can you start by describing in simple terms what is Primary Venture Partners, when was the fund started, and what are your main investment areas, both in stage and in sector?
Yeah, absolutely. So Primary is a early stage venture capital firm based in New York City. We have been around since 2015, and we're investing out of our fourth fund now. That fund is a $280 million fund, and then we have an additional $165 million fund to do follow-on investments into existing portfolio companies. So at this point, we have around $1 billion AUM, which is pretty big for a seed fund. I think it makes us the biggest early stage VC in New York. And we do things a little bit differently at Primary, I would say. And it's one of the reasons why I think it's a unique firm to work at and to partner with if you're a founder. So we have a team of like 40 or 45 people here. That might even be underselling it. Only a third of us are actually investors. 2/3 are on a team that we call our impact team. And their whole dedicated sort of time here is to support portfolio companies after we invest. So we help with things like go-to-market and customer introductions, hiring and recruiting, strategic finance, governance, and kind of CEO coaching and mentorship. So there's a bunch of different things that we do for portfolio companies once we invest, which is a big difference in how we operate. In terms of our investment strategy, we really only lead. We're a concentrated fund, so we make maybe 12 to 15 investments a year. Most of them are seed investments. We'll occasionally do small pre-seeds. We'll do some small Series A's pretty rarely, and then we'll also incubate businesses. And so the average check size ends up being something like $3 or $4 million, but the whole range is something like $1 million on the low end to $7 million on the high end. And we invest across all sorts of different sectors and categories. So every investor on the team is quite specialized. As I'm sure I'll talk about a lot, I invest in more technical companies, software infrastructure, data infrastructure, developer tools, and cybersecurity. But we have other investors on the team focused in other areas, things like healthcare, fintech, supply chain, consumer, prop tech. So we're very generalist as a firm, but every investor is pretty specialized.
Awesome. Thank you for that. Could you maybe quickly describe what your background is and sort of A, what led you to Primary, and then B, to that coverage area, which is fairly technical?
Yeah, for sure. So out of college, I was a public policy major in college. I didn't know exactly what I wanted to do, but I went to a school where a lot of people did investment banking and consulting out of school, so I figured that was like a good thing to do. And so I went into consulting. I worked at Deloitte for a little over a year and a half doing like mostly public sector work. They had a really interesting group in DC that did kind of like public sector strategy consulting. So I worked there, which I thought was like a good mix of what I had studied in school and also doing something that was kind of accessible from school, which was management consulting. I realized there that I wanted to do earlier stage stuff. I wanted to do something involving startups and entrepreneurship. And it's a long story of how I got to that conclusion, but I got to that conclusion pretty quickly. And ended up going to work at a company in New York called Radical Labs, which was being incubated by a venture studio in New York called Prehype. This is in late 2016, early 2017, at a time when the venture studio model was really, really nascent. And Prehype was one of the first, if not the first, pure studio model operating in New York. They had incubated a couple of pretty interesting businesses at the time. And so I joined with sort of a unique perspective of being able to work at the startup. I was kind of on the founding team of employees and also constantly be around other entrepreneurs in the studio who were building businesses. One of those businesses ended up being Row, the digital health company that ended up raising a bunch of money and scaling really quickly. So it was an awesome experience. The company was really trying to be like a pitch book and CB Insights killer. We had strategic investment from Dow Jones that gave us access to all their proprietary sort of longitudinal historical data. And we were trying to build an insights platform for corporates that wanted to invest in or partner with startups. And we had a team of like 12 or 15 people building that product. And it was an awesome experience. We had customers, we had different products that I helped build. And it was kind of a crash course in startups as like a 24, 25-year-old building stuff, selling stuff, helping to hire people, kind of like the full gamut. I didn't really know this at the time, but We were doing a lot of stuff at that company that was really at the beginnings of using kind of what became the modern data stack. At the time I was there, we had a data scientist who ran kind of like the data sort of apparatus of the company who was using Jupyter Notebooks, and Jupyter Notebooks was this incredible thing in 2017. It's now sort of crazy to think about it as an innovative, amazing thing, but it was at the time. I had that experience. I knew I wanted to remain in kind of the startup ecosystem, either joining another startup, starting a company, or maybe experimenting with VC. I didn't really know what that would look like. I went to business school, as you mentioned, I went to Wharton, kind of to figure out which of those paths was going to be the right one for me. But before I joined business school, I met one of the founding GPs at Primary, Ben Sun. When Primary was still, it was a very different place than it is now. I mean, philosophically similar, but in terms of its scale and in terms of its brand, much, much smaller. But I had an immediate connection with Ben around the way he thought about venture. He wanted to incubate businesses, and I had this experience at Prehype helping to basically build a business from incubation, sort of inception stage, and had seen how a studio could work over the past almost 3 years. So I ended up interning for Ben before business school, and then during my first year of business school, while I was kind of trying to figure out what to do, I took some Python classes in business school. And then I ended up joining Primary after I graduated. I worked for a different partner in my second year of business school, Brian, who I still work super, super closely with. And when I graduated, we didn't have this orientation and strategy as much as we do now around specializing the investment team, but that started to emerge probably in the first 6 months of me being at Primary. Brian had been working really closely on an incubation of a company called Plural, which is a DevOps business. It's like a Kubernetes fleet management business. And I was kind of interested in that stuff. It wasn't well covered at Primary. It just sort of made sense to go all in on that and work with Brian on that. I've been at Primary now for a little bit over 3 years, so almost 2.5 years later. It's really the only thing I've done for the past 30 months, I guess, is think about software and data infrastructure, developer tools, DevOps, and cyber. I probably spent 50% of my time on cybersecurity now and 50% on all the other stuff, and it's been a blast.
Great. That is a super interesting career story, both starting at the super big company at Deloitte, which is actually where I also started my career, to then going to a very small startup. That's been quite a change. You mentioned a couple of times the role of incubators, both when you were sort of joining the startup that you did and then Primary really going down that path of wanting to incubate startups and being really hands-on from an operational perspective. First, for those who aren't really familiar with the incubator model, could you maybe describe what that is and sort of the value that it provides to the startups who work with the incubator? And then maybe what was the GP's thought process behind really making Primary sort of this operational and incubator-led venture fund, given that that is a lot different than how maybe some other venture companies or funds operate in the space?
Yeah, I would say incubation is part of what we do. It's certainly not the main thing we do. We invest in probably 12 to 15 companies a year. We'll incubate 4 companies a year out of that 12 to 15. So incubation is a really significant part of what we do. And we see it as a way to manufacture and create really amazing opportunities as opposed to having to wait for them to come to us. I wouldn't say we're led by incubation. I'd say it's a big part of our strategy and a big part of what we do in addition to the traditional investing. In terms of incubation, incubation can mean a million different things. It's a very sort of vague, amorphous word. When I joined Radical Labs and within Prehype in 2017, the de facto thing people thought about when they thought about incubation was Y Combinator. And I would really not consider Y Combinator an incubator. I would consider it a really big scaled pre-seed fund. They're investing in existing teams. They're super, super early. But they're investing in people who have ideas, who apply to the program with those ideas. They're helping them nurture those ideas and progress on them and make them better. But at the end of the day, they're making direct investments into things that exist. And the way we think about incubation, more so Primary, is creation. Something does not exist. There isn't even a founder. Let's have a team that generates ideas, puts structure around those ideas, really rigorously diligences and researches them. And then if we get really excited, let's create the company and let's create the founding. Let's put together the founding team, put together the business, capitalize the business, and go. It's a different way of thinking about incubation, really where we're the generators of the initial kernel of the idea as opposed to investing in an existing team.
Got it. Thank you for that clarification and for that sort of explanation of what incubation is. Diving a little bit more into the areas that you covered. So you mentioned data and developer tools and now cyber being a really big part of the areas that you look into. Could you maybe describe why you're excited about it and sort of what drew you to the industry in the first place? Because you sort of mentioned that very quickly, this is something that you sort of tool into. And as a result, what are the opportunities that you're sort of most excited about in the space?
For sure. I would say there's a cliche, and I think not just venture investing, but just investing in general, around investing in picks and shovels. And to explain that, it's like during the gold rush, people who struck gold did really well, but so did the people who were selling the picks and shovels, the people who were trying to find gold. And I think of developer tools and infra stuff as like ultimate picks and shovels type of investing. It's like, how do we enable people who are building things that will be really valuable to have tools to build those things more efficiently, more high quality, or to enable more people to build things. So at a high, really macro level, that's, I think, what's interesting to me about it. I also just sort of think that we're at a place now in the economy with technology businesses and even non-technology businesses. It's like every single business is now kind of like a technology business in some way. And the stuff of building technology is software and data infrastructure. And the way that companies create value out of technology is by leveraging those tools, harnessing the data that they have around their customers, around channels, around products, driving value from that data. So it's such an imperative part of the economy writ large now. It's just a really fruitful thing to be investing in. There's like two other things here, though. I mean, I do a lot of cybersecurity investing now. Cyber is a unique category in a lot of ways because there's always threats. It's different than a lot of other categories where there's people attacking you and you have to like have the best defense system. And the attacks are always evolving, especially with AI. CISOs and cyber leaders are always excited about buying new software because they need to ensure that they don't get hacked and there aren't malicious attacks that get through. So it's like a really good area to invest in. There's like always new tools. There's always new technologies that people want to buy. And then the last thing I'll say is that AI has, I think, changed a lot about the way we think about investing. We've been pretty selective and thoughtful about AI investing. There's a lot of hype, and I think we're definitely in a bubble. But it's been a really cool. I have felt very lucky to have been in this seat while the AI wave emerged because it's enabled me to do AI infrastructure investing. And if we really believe that AI systems are going to be an important part of our lives and an important part of the products that companies serve to customers in the future, there's going to need to be some new infrastructure to support that. That's been a massive tailwind, obviously, around the kind of investing that I do.
Yeah. A lot to dive in on there. So first, when I'm thinking about AI infrastructure, could you maybe sort of paint the picture of what type of company that actually is? I mean, I know data is a huge part of developing good LLMs. So is AI infrastructure the tools that OpenAI or Microsoft use to basically get data and then train their models on it? Or is it then the infrastructure that the models then run on themselves? Could you maybe sort of describe a little bit more in detail what that actually is?
The way we've been thinking about the AI stack is kind of with 4 layers. And I think you can sort of, VCs have different blog posts about this, and there will be slightly different versions of this, but it's basically, you've got compute, like hardware. GPUs dominate that market right now, specifically NVIDIA GPUs. You have models, which is a market that's really dominated right now by OpenAI, although Anthropic is close second and Google too. And the reason why those things work so harmoniously together is the chips have to be really, really powerful and really good at parallelizing massive workloads and sort of basically math equations to run those massive models. The big thing that's happened with these models is that they're really big. They're called large language models because they're really large. They have they're trained on a massive amount of data. And so they need really incredible chips to run them. So we have chips, we have the models, and then we have what I would call like middleware, sort of helping companies use those models to build stuff, or helping developers use those models to build stuff. Things like LangChain are a part of this, but there's a lot of different tooling that's emerged and that got a lot of funding last year. in this kind of bucket. And the way to think about this category is similar to the machine learning ops, ML ops category for traditional ML. That's kind of like this category for LLMs. And then you have the application layer. So ChatGPT is an application that's built on top of a large language model, things that consumers will engage with or even business users will engage with. That's generally how I think about the stack. What I would cover at primary is the bottom three, like middleware tooling, actual LLMs, foundation models, and chips. And there's a lot of nuance there. Each of those categories has a bunch of different subcategories. And then there's some companies or some opportunities that actually, it's unclear which bucket they're in because they kind of bleed across different buckets. There's a company we've been talking to for a bit now that is kind of in that category that's doing like GPU optimization. Would you put that as like a hardware company? It's not a hardware company, but it's not really a middleware company either. It's pretty low level. So there are some sort of edge cases, but that's broadly speaking how we think about the universe of AI companies. And I cover the bottom three with Brian. And then other teams at primary, depending on the sector that the application is in, will cover app layer AI businesses.
That's very interesting. I'm curious for your thoughts, given especially in the infrastructure and I guess AI writ large in general, is that you have these incumbents today, like your Googles, your Amazons, your Microsoft, that own so much of the distribution and the ownership of compute to a certain extent today. Do you think there's more room for disruption from startups in AI and the data space, or has it become quite a challenge given sort of like the oversized roles that these incumbents play, both from just like the resources they have to develop new products, right? If I'm thinking about like a Microsoft, just being able to sort of create a lot of elements that would maybe otherwise have been founded by startups, but also from the distribution perspective, right? They own a lot of those enterprise relationships today, and a lot of people are already on their cloud services. So why would you move on beyond that? So kind of curious for your thoughts there in terms of sort of like the role startups play in a really difficult environment where the incumbents have quite a big piece of the market.
Yeah, I mean, this is a really good question, and it's one that VCs have been asking really since the AI boom began. Another way of framing it is like, is AI a sustaining technology, which is going to benefit incumbents, or is it a disruptive technology, which is going to benefit startups? And there's a lot of literature written about what kinds of technologies end up being sustaining technologies versus disruptive technologies. Ben Thompson has written a ton about this. The real answer is I don't know. I mean, we'll see. I certainly think that incumbents are really well positioned to capture a lot of the value coming from AI. I think all the stuff that Apple has done over the last week or two is super interesting too, because they're kind of forgotten mega tech company in the AI landscape, but they're, I think, really well positioned to capture a lot of value from AI too now, and the partnership with OpenAI and embedding ChatGPT into their devices shows that. With that said, I think there are going to be opportunities for startups to become really, really big businesses. We forget about the scale of these opportunities sometimes. And sometimes it doesn't really matter as much how much of the pie goes to incumbents versus startups, as opposed to like how big the pie is. I'll give you an example. Coatue had this really good report. It must have been 6 or 9 months ago now or something like that, around the year of 2023 in AI. So it must have been closer to 6 months because I think it was done at the end of 2023. And they have a lot of really great stuff in that report. One slide in particular was really interesting. What they did was they basically took mobile as an analog, quote unquote, tech platform shift and said, okay, let's take 2008, which is when the mobile revolution began with the iPhone, and say, who are the incumbents that benefited from mobile and which incumbents would we classify as mobile first businesses now? And what were the like startups that were started that were mobile native companies? Think about Uber and Airbnb and DoorDash and even TikTok, like all these canonical tech companies now. And let's compare the market shares of the public companies that were incumbents from 2008 to today against the collective market share and valuation of those startups. And the collective valuation market share of those startups is over $1 trillion. It's like a massive amount of value. But the market share of the incumbents, it's like 12 or $14 trillion or something crazy like that, the increase. If you look at that, you say, wow, 90-something% of value from the mobile platform shift went to incumbents. But you'd also be crazy if you said, oh, that means you shouldn't have invested in mobile startups. Incumbents were massively successful and massive winners, and startups, a handful of startups were massive generational companies because the pie was so big at the end of the day. I think it's really hard to make the case that most of the value in AI will go to startups. I think it's really hard to make that case. OpenAI is such an outlier, and so like they throw things for a loop a little bit. But I think it's hard, generally speaking, to make that case. I think the easier case to make is something like the pie will be so big that incumbents are going to benefit a ton, probably way, way more than startups, but there will be massive generational startups too. And I think that's the point of view that I'm more a believer in.
Yeah. I agree that AI is super exciting, but I'm always going to, just for the devil's argument, can take the contrarian point here and say that if I were to compare it to mobile, which fundamentally changed the way that consumers interacted with the world around them, being able to have Airbnb and Uber and all these other companies that never would have existed before. Yes, AI is obviously transforming sort of the way people do work today. For example, at my internship over the summer, I'm doing a lot of data analysis and reporting building, and there's all these chat integrations. So basically, natural language is what they're calling the new sort of software language. And so I can just write a prompt and it'll give me a SQL query. But it's not actually transforming fundamentally. It's helping the business that I'm doing today, but it's not necessarily fundamentally transforming in the same way of that disruptive versus sustaining technology. I guess, do you sort of see applications of AI that fundamentally sort of change the way business is done today?
I think it comes down to automation and how much automation you can create. I don't know. I think this is the question. And AI could be a total dud, in which case none of this really matters. But Klarna is talking about automating their whole customer support team and things like that. So we'll see. I think it's a good pushback. Developers are coding whatever, like 3 times as fast as they did before with Copilot. And if you like think about the downstream implications of developers writing 3 times as much code, it's kind of mind-boggling to think about the compounding effects of that. I think we're in inning like 2. I think we're very, very early. And I think that a lot of the value will be consumers having crazy experiences. And ChatGPT was a kind of a crazy type of experience for consumers, but I think there's like way more to come. But a lot of it's going to be around business process automation.
Yep.
It will be less like visceral
basically just like
in some ways than mobile.
I can see that. So basically just augmented RPA to a certain extent. That's a little bit more interactive than what exists.
Way more complex processes in theory, right?
Sure. Moving over to cyber, you sort of alluded to it in the beginning in terms of, again, coming back to AI in the space, and there's probably no way to avoid this topic in general, is that it's fundamentally, I think, like kind of shifted somewhat the cyber ecosystem in terms of the threats are now much more complex and evolving in sort of the same way that the automation will become more complex in the future. Has that been a real accelerant of cybersecurity space? And if so, how similar does the investing look like to the areas that you cover within data and developer tools? Because at least to me, it seems like a lot of cybersecurity is really sitting in that application and services layer and less so in the infrastructure.
Yeah, it's a good point. So, I mean, when I think about cyber and even dev tools, those are application layer businesses, but they're just targeted at a technical user. I cover both of those things, like infrastructure in support of sort of horizontally like the business, but also applications that are used by technical people. So it's a good distinction, and cyber definitely falls into the latter category. In terms of AI and cyber, in 2023, when there was like all this AI hype, there were tons of cyber businesses that emerged sort of doing all sorts of things around new attack vectors created by AI. I mean, one sort of very common one that we got pitched a lot was your employees are going to use ChatGPT, or if they don't use ChatGPT, it's probably because you've banned ChatGPT. But the reason why it's risky for them to use ChatGPT is if they leak some sensitive information into ChatGPT and it hits the OpenAI API, and suddenly you've lost the security and confidentiality of like this important piece of data. Let's build a firewall that sits between the ChatGPT application and the OpenAI API, and will catch things that shouldn't cross the wire, so to speak. That was like a very common pitch that we got early days of AI. Honestly, a big one too, there's a lot of manual work that goes on security teams with like SOC teams and sort of threat and intel teams of writing reports and stuff like that. So a lot of companies are trying to automate those things with AI. So there's a lot going on. I think we're still pretty early in figuring out actually what the problems are. It's interesting. We don't really have yet a ton of productionalized AI sort of use cases. And some really big companies, like I mentioned Klarna before, Palo Alto is another, ServiceNow is another, are starting to generate insane value from AI. But it's not like ubiquitous across every company. And As a result, it's hard to know like what the real attack vectors are that people actually care about because it's not in the wild yet. So we think there's a ton of opportunity. We're actually working on a cyber meets AI incubation right now that we're still sort of early in, but getting excited about. But I think we're just too early to know. And there will be a lot of opportunities. And I think there will be things about leveraging AI that are risky that we don't even realize are risky yet, but it's just really early. The other side of this, though, is that attackers are now using AI in a bunch of interesting ways to try to perform more sophisticated attacks. So there's using AI as a defense. There's also combating AI as an offense. That's pretty interesting, scary when you think about kind of what attackers can do, but interesting and important stuff to be investing behind. We're thinking about that a lot too. We've looked at a few companies that are doing phishing simulation using AI. So that's an obvious application of some of these LLMs. It's like you can generate such realistic phishing emails using LLMs. And that's obvious stuff that attackers are, I think, already doing and going to ramp up in the future is just like very sophisticated and very realistic phishing emails that they can just send in crazy volumes with AI. So there's a lot, but it's still very, very early.
Yeah. It's like outbound sales, but for phishing, empowered by AI. It's funny.
Yeah, totally. And pulling information from all over the internet to make it way more realistic than it ever was before.
Yeah. In terms of, you mentioned kind of at the beginning also that cyber is a really interesting area because a defensive one, and it's almost one of these things where if companies are so afraid of being hacked and being attacked, that they're almost willing to do, correct me if I'm wrong, but they're willing to spend a lot of money to save themselves from the hassle of being hacked. But on the flip side, I would wonder that it's maybe kind of hard to see sometimes the efficacy of some of the products because the product that you may have today may be good enough and you haven't been hacked as a result and your company's information hasn't been stolen, but it's not necessarily really ready for the threats of tomorrow. So how do the companies that you look at and invest in sort of crack this go-to-market motion of really sort of maybe convincing people of the threats of the future and the fact that they do need to buy future software?
Yeah, it's a good question. I have a friend who used to be a VC and then he started a company, but he's a super technical VC. And he said this thing to me once. He was like, DevOps teams, their budgets are 80% people, 20% software. Cyber teams' budgets are 80% software, 20% people. And the reality of cyber is that there is this norm in the CISO community around buying tools and buying software. And it's very trendy. If I'm a CISO and I hear that my CISO peer has bought this new hot thing, if I don't buy that new hot thing and then I end up incurring an attack or a breach that could have been prevented by that new hot thing, I'm probably fired. So a lot of this stuff is like insurance. It's like being best in class so that I can have deniability around things when things go wrong and explain to my CEO or my CTO or whoever I report to, like, hey, I had the best in class suite of tools. There's nothing we could have done. We had the best tools. We had the best response system. We got attacked and then we responded quickly and we've mitigated it as much as we could. The bad thing if I'm a CISO is like, I'm just not up to date on my tools and then I have no excuse. I think CISOs just think differently about software than a lot of other buyers. This is how they survive, as opposed to let me buy software to like squeeze a little bit of incremental juice out of this part of my infrastructure or this set of developers. So it's just a really different way of thinking about it. Your question about sort of present day threats versus future threats is a good one. CISOs are very smart. They're very savvy. They're thinking about threats way before they even exist for their companies. You talk about AI security. Most CISOs don't have to deal with that right now because they're not implementing complex AI systems in production. They're all already thinking about it. It's like their job to think about it and to forward looking. So they may not be buyers yet, but they're certainly thinking about every problem they have before they actually have them. And they don't want to be caught flat-footed, so they're very open to buying. That's kind of the dynamic. It's a good question, though. And obviously, with every type of enterprise software, there's always a motion of trying to convince someone that they need the thing. But in security, the sort of like universe of threats and the universe of problems that CISOs have is way more defined and people just like understand them better.
Yeah. Do you think, though, as a result, kind of going back to the AI question, it's a combination of these two themes, is that right now, I think for an AI to be really key in actually enabling for a company, it really needs to know be trained on the data of that particular company. But then it sort of raises the question of, for example, a bank, like would JP Morgan put their data on the cloud to be then mined by OpenAI? Probably not. And in that world, do you see some of these things, maybe some of the services in the infrastructure returning back to on-prem to enable companies to then create LLMs that are trained on their data, just hosted internally, which would make it safer from a security perspective?
Yeah, it's a good question. Different kinds of companies are going to have very different postures around this. Massive banks like JP Morgan manage a ton of their own on-prem infrastructure, and they always will. They're never going to be, Capital One went fully to the cloud, which is a unique situation, but most massive financial institutions are always going to have a ton of on-prem infrastructure. And if they want to train a model, or if they want to fine-tune an existing foundation model with their own data, they're not going to do that in all likelihood in the cloud. They're going to have a team do that on their own infrastructure. It may be in partnership with OpenAI, because OpenAI now selectively for some really big Fortune 500 companies is doing bespoke on-prem fine-tuning of their foundation models. And you can actually, they'll serve one of their foundation models to you on-prem if you're big enough and if you're worth the work, basically. It's going to be interesting. A lot of companies house their data in the cloud, house customer data in the cloud. Snowflake is like a cloud native analytics database that has a lot of sensitive information in it. And companies host massive database instances with all the big hyperscaler cloud providers, Google, AWS, and Azure. We'll see. It'll depend on just how normalized this becomes. OpenAI has become so tethered to Microsoft, and now they have this joint Azure API where you can access OpenAI in an enterprise-grade Azure API. That's going to be good enough for some people. They already do a lot of stuff via the Azure API in the cloud. Some others will be more sensitive about that, and they'll have to do stuff on-prem. And if they want to do stuff on-prem, they'll either have to have really big teams or they'll have to pay more for services-oriented stuff. But it'll be a mix. It'll definitely be a mix.
Yeah, great. That's super interesting. Closing it out, one of the questions we always like to ask people on the podcast is sort of career related, given that we are ultimately a business school podcast. So I know venture is a very exciting place and a lot of people want to get into it, but it's often sort of notoriously difficult. So what are maybe some of the recommendations that you would have for Wharton MBAs or anybody in general looking to break into venture? Sort of what are the places that they should be looking? What are the places they should be reading or ways they should be trying to break into the industry?
First thing I recommend is to really know yourself and play to your strengths and go really hard at something that you think you know or you think you can do better than anyone else. Because venture is so competitive, if you're the third best healthcare investor that a firm talks to, they're going to hire the first best healthcare investor. So you got to focus on something that you're confident you can match up against anyone, anywhere, anytime, and be better than at that thing. Usually that revolves around a sort of sector specialization, and experience is tied to that sector specialization. But it doesn't have to be that way. I got into venture and I got my foot in the door through this unique incubation experience that I had. I met Ben when he was thinking about incubation and wanted to work on incubation and bring someone on to help him with incubation. And I was that guy in New York who had done that. The reality of specializing and of picking a lane and really sticking to it is that you're going to limit your options. Not everyone's going to be looking for that specialty. But with the people who are looking for that specialty, you're going to increase your odds of converting it into an internship or a job. It's not helpful to be the fifth choice at 20 places. It's way better to be the first choice at 2 places. Specializing is good. It's usually going to be around a sector, around a set of experiences that you've had, but it doesn't have to be. That's the first thing. The second thing is, and this is related, is that I always recommend business school students parallel process recruiting for VC and recruiting for a startup. Because especially if you want to be an early stage VC, having operating experience at a high growth, exciting startup that investors know about and investors know the reputation of and doing really well at that place is probably the best signal you can give to VCs who are looking to hire. It'll help you in the job too. It helps you understand the market that company's in better. It helps you empathize with founders and founding teams better and understand what they go through. And the interview processes across VC and across startups, especially more strategic roles that a lot of business school students are going to be recruiting for, have actually a lot of overlap. It's like if I'm recruiting for VC, I'm going to be asked, what are some interesting startups that I'm tracking? What are some interesting markets? How do I think about those markets? Those are the kinds of things you're not only going to be thinking about, but also learning about talking to startups. I always recommend parallel processing those things. I don't really think it makes sense to pick one or the other. There are some people who just want to operate, and for them, it's like, I get it, just recruit for a startup. But if you want to do VC, I think the number of roles open is so limited. It's so competitive, especially at a business school, that I always tell people parallel process VC recruiting and startup recruiting. And then the last thing I'll say is like the currency that you should be operating in as someone looking for a VC job is like introductions and insights. When you can make an introduction to a VC, to someone who is valuable to that person, be it like a founder or an operator or whoever, that's gold. What's also gold is when you teach a VC something and you give them an insight around something that they care about and that they're interested in that they didn't know before. Getting real insights is hard, and it requires like really either reading good high quality stuff and then having your own kind of like insights or opinions related to it, or primary research around talking to startups and talking to operators. But getting insights and being able to make really high quality intros, it ends up being the best currency to use with investors to leave an impression on them. And I would say basically the only thing I read is Stratechery by Ben Thompson. I don't even know how much it is. I think it's like $120 a year. It's like $10 a month or something like that. It's like the best money I spend every year. It's gold. Each thing he writes is just, some of it's more relevant to me than others, but the way he thinks about businesses and markets and sort of competitors and partners, and it's like amazing stuff that will make you smarter about how startups work. So that's my last recommendation, is to read Stratechery.
Awesome. Well, those are all great pieces of advice. So really appreciate you giving them. And thank you so much for joining the show today. Really appreciate it.
Thanks, Julian. I really enjoyed this, and thanks for having me on.